Every year on April Fool's Day, we release a new Fool or Forecaster report. Writing this report is a mammoth task as we compile as many predictions as we can lay our hands on and compare them to what actually happened in the previous year. And as you can expect, 2022 was a doozy. So many unexpected things to skittle those carefully crafted forecasts. And in keeping the forecasters to account, we didn't restrict ourselves to property price predictions. This year, we also tracked interest rate predictions. Now, stick around if you want to know who got it right, or perhaps a better way of phrasing that is who got it the least wrong. Welcome to The Elephant in the Room. This is the podcast where we love to talk about the big things in property that never usually get talked about. I'm Veronica Morgan, real estate agent, buyer's agent and buyer's agent mentor, co-host of Foxtel's Location Australia, author of Auction Ready and co-host of Your First Home Buyer Guide.
And I'm Chris Bates, mortgage broker, recently ranked number 5 in Australia out of over 18,000 brokers in the annual MPA Top 100 Mortgage Broker Awards. Before we get started, I need to let you know that nothing we say here can be taken as personal advice. We always recommend you engage the services of an appropriate and experienced professional.
Before we launch into who got it right and who got it wrong, we want to be clear that we're not bagging out economists. Even though it's mostly economists who make property predictions, we've learned so much from all the guests that we've had on the show, particularly the economists we've had on the podcast over the last 5 years, and a special shout out to the economists who have come onto the podcast in 2022. We thank you. I'll quickly run through their names. Cameron Kusher, Saul Estlake, Dr. Cameron Murray, Brendan Coates, Nikki Hutley, Steve King, Chris Leishman, Carlos Cacho, Paul Ryan, Belinda Allen, Felicity Emmett, as well as respected researchers Eliza Owen and our old mate Kent Lardner. Now, right, with that out of the way, let's talk through the roller coaster year that was and highlight those who bucked the trend and anticipated the interest rate rises and subsequent impact on the property market. So if we go back to the last quarter of 2022, Chris, what do you recall?
Oh, 2021 you mean, as in terms of...
Yes, I mean that, 2021.
And that's the thing, we are going back quite far in time. We're going back about 15 months and the world was a completely different place. No, I don't need to tell you that, but we had very low inflation, declining inflation all over the world. All the governments around the world were predicting, very modest inflation, if at all, in the years to come. Growth was meant to be subdued. And we all know that 2022 didn't happen like that. As the start of 2022, there was a bit of a rising expectation that interest rates were going to go up, even though the RBA said they weren't, but nothing like what happened over the next 12 months. So there was so much research that we both did, and there was literally every article you read was pretty much wrong by a long way. And so it's going to be a good chat today.
Well, it was interesting because I remember the headlines started talking about potential for price falls at the end of 2021, but they weren't really referring to inflation as being the cause of it. And I think what was so interesting when we look back over the year that was all the external factors that really impacted on the economy and on inflation, which meant that interest rates had to go up, which obviously has a knock-on effect to the property market. And so it was almost like prices must start to fall because 2021 was such a hot year that it was almost, and we could see that growth had slowed. CoreLogic data had definitely shown that. So prices were still rising, but at a much slower rate, more controlled rate than they were at the beginning of 2021. And it's almost like because we were slowing, not declining, the headlines were all talking about sort of falls, price falls, but without any real basis behind that other than, well, what goes up must come down sort of logic. Whereas there was actually bigger, much bigger tailwinds brewing, or headwinds, I should say, brewing, that we were blissfully ignorant of, particularly, and I think it all came crashing down when the Ukraine war started. It was like everything seemed to just, basically land at the same time. And then we really saw an impact on inflation.
Yeah, I think you're right. I think the fear going into, there was no fear going into 2022. I think everyone knew that growth was going to slow down, because of the severe rise in prices over 2020 and 2021. And they weren't sustainable. And there was talk of rates going up. And I think everyone knew that, but no one expected that, you were going to see a 3% increase in interest rates, a 30% reduction in borrowing capacity, And a complete freak out event, right? Where no one knew interest rates were going to go above 4 to 4.5% at one point, and no one would have thought that. And, when you look at how the market held up after that, prices corrected really fast, but not as significantly. Chris Joye came out in October 2021 and was probably one of the first, and we're going to give him a bit of a pat on the back here, because he's one of the first that started to bring up the conversation that, look, guys, there's going to be some pain ahead when the RBA increases rates. But he, in his mind, and if you look at his articles in February and May 2022, he was thinking maybe rates, the RBA is going to go up to 1 or maybe 1.25 or 1.5. He wasn't basing his expectations on the RBA going to 3%, which they did. And that would be a 30% reduction to borrowing capacity. So, Chris was right in some sense that price falls were going to come down the line, but, he wasn't expecting inflation and interest rates to go anywhere near what they got to.
So, and that goes to what I was saying before, is that I think those who were starting to talk down the market at the end of 2021, they sort of got it right, but for the wrong reasons. And, I think too, what's interesting with Christopher Joye in particular, he said that prices, could fall up to 25%. And unlike all the other forecasters, he hasn't revised that at all. And he's yet to be proven right or wrong, because, we're not yet at the end of this cycle. So, but we're still a long way off 25% at a national basis. So he might end up with a gong next year, because, at the end of all this, it may not all pan out. But at the moment, I guess he's getting a gold star because he called falls before nearly anyone else did. And there weren't many people that were prepared to buck what the RBA was saying, because if we all remember, the RBA was quite vocal in saying that they didn't expect rates to rise until 2024, which did feed a lot of confidence into the market. And in retrospect, highly unfortunate for, a segment of the market. People piled in at the peak, particularly first home buyers, with very small proportions of equity. Obviously they're hurting a lot more than potentially somebody who's been in the market for a lot longer. So, there's some damage that was obviously done by that and by people taking action. But, it's so interesting, though, but looking back, and when you got the report on our website, which is theelephantinaroom.com.au. If you want to read all of this stuff and read it in the chronology of it, then please download a copy of the report. But when we were writing it, when we were reviewing all these predictions, it was just so interesting to look at January 2022, and almost everybody, a couple of gold stars for people that did stick the neck out and say that, prices could fall or would fall for the year. And overwhelmingly, it was believed that prices will continue to rise, albeit at a slower pace. There was a number of economists that would start talking about, we probably could see the interest rates might start rising in November 2022. It's almost like they just want to duck in before the end of the year to say that they could claim that they said that rates will go up in 2022. But really and truly, it didn't start, those sort of predictions that actually rates could go up earlier in the middle of the year, that didn't really happen, I wouldn't say, till April. In fact, in April, there was revisions of predictions. There was a prediction at the beginning of the month and a prediction at the end of the month by a number of institutions. And it was really interesting just to see this frenzy whip up. But in February 2022, when, we know that that's the Ukraine war, it's almost like the catalyst. It feels like the catalyst. I'm sure it isn't the catalyst, but it's certainly a big factor here in terms of creating energy price problems and obviously the contributing effect of that on inflation. So that seemed to be the point at where all the forecasts seemed to all get skittled for a bit. There were, even ANZ at that point revised their predictions for price movements upwards. In the middle of all this, others were revising them down. It was just this total mess of predictions. And so looking at February, it was like this sort of pivot, this turning point. It was such an interesting month to make. You can't make sense of it really, because even in retrospect, it looks ridiculous.
Yeah, I think we've been doing these reports for 5 years, and why we do it is a bit of fun looking back in time and just going over the year and what happened. And it's great for us just to bank that memory, right? And what actually happened and what everyone thought prior and what ended up happening. And but I think even in going into 2023, the same's happening again. We're finishing quarter one. No one would have expected things that we're seeing in banking systems, right? Credit Suisse and Silicon Valley Bank and market expectations of interest rates have gone from 4.5% down to 3.5%. That's a huge swing in a quarter. And so when we do this next year, we're going to get the same learnings that we got this year, where everyone's going to potentially think the market was keep falling, but maybe the market's going to go up. I don't know. So I think what's the interesting thing is here, when you look back in time, you can see how difficult it is, forecasting. And I think you're right. The swings were so grand. And same in 2020, when you COVID, everyone thought the property market was going to fall dramatically, and it didn't, right? Same thing here. Everyone thought the property market would keep going up in 2022. It didn't. It actually went down quite significantly. And so if you based your recommendations on what all these economists sort of said in the start of 2022, or what the bank said, there's a Sydney Morning Herald article, which we've got in the report, which says all the banks thought that interest rates would stay really low in 2022. Obviously, they didn't. Even the market pricing, sometimes you think, well, I'm not going to listen to the banks. I'm not going to listen to the economists. I'm going to look what the traders are doing. They're the ones in the know. Well, they thought interest rates would go up to just over 1% in 2022. Obviously, they didn't. The market actually got it right, though, I found, once they got to sort of April, May, I think the market realised that the inflation problem was quite grand in scale, and it would take a significant effort in terms of the RBA increasing interest rates. And they were basically saying, look, we think that the interest rates are going to go up to circa 3 or 4%, even though the banks weren't thinking that. So the money, I think, got it right by the middle of the year. And, we're looking back at some research around the money. You can see that, over the last decade or so, the market kept thinking rates would go sideways or go up, and they just kept falling. The RBA just kept on cutting rates, and the market kept on getting it wrong. They kept on thinking rates would stay steady or go up. And I think that's just a thing to know, that the money doesn't even know where rates or property prices are going to go.
And that's the problem, right? Because there's this fallacy that they do know, and a lot of money hinges on this. And it's like, how long is it going to take before anybody actually works it out? The blind leading the blind. And I think it seems so obvious now, but when you sort of deconstruct this and tease this all out like we've done, the RBA basically got their forecasts on inflation wrong. And then because they got their forecasts on inflation wrong, they got their forecasts on interest rates wrong. And then because they got their interest rate forecasts wrong, and they were quite open about it, or about their wrong forecast, not the fact that they got it wrong. But anybody that basing their forecasts on that information were also going to get it wrong. And this is the problem, that you can trace this all quite clearly back to the one source, really, when you think about it. And it's like, why? Who is a greater fool? The economist who bases their models and their forecasting on this information and then publishes it, and then, or is it the person or the institution that actually pays attention to this, to these forecasts and act on them? Because I think we've got to wake up and realize that this game of trying to predict what's going to happen with the property market, it's a joke. It's an absolute joke.
The RBA is an interesting one to look at for this research. So every quarter they do an economic outlook. There's links in the report. And so I went back and I said, look, what's the November 2021 outlook for inflation? And they said, well, in 2022, probably going to be low twos, right? And by the time February came around, they're like, maybe inflation's going to be 3.5%. That's a big difference in 3 months. Worst case, it may get close to 4% in the coming years. But, if there's another COVID outbreak, maybe it's going to go back down to 2. So there was obviously fear around, there in Feb 2022. But by May, so this is after Ukraine, right? We got it wrong. It's not going to 3. It's going to potentially 5. And it's going to be sticky. This isn't going back down for at least a couple of years. So they were freaking out a little bit here. And then this is when it really, so then it goes, it's going over 8. So in August. So they've gone in the space of, November, which is 9 months, from, hey, it's nothing to watch here, nothing to see. Inflation's going to be 2%, to inflation's going to be 8%. And this is going to stick around. And then when they get to November, it's obviously hit close to 8%. And that this is going to be quite sticky now. It's going to stick around, till 2024, 2025. So you got to look at the RBA here. what a flip in 12 months. No inflation, it's going to be 2%, to actually we're hitting 8%. And, that's obviously caused the response in terms of the interest rates.
And look, I mean, there's a lot of calls for heads to roll. And you can understand why, especially when the central banks in other countries seem to see the writing on the wall earlier and do something about it. And so there's lots of arguments there. Now, we're not economists and we're certainly not experts in monetary policy. But from an observer's point of view, and because particularly for this report, we get to sit down and look over all the predictions with the benefit of hindsight. Now, I'm not foolish enough or clever enough, potentially, to come up with a forecast. So I'll never get a Gong, nor will I get a gold medal. And so it's easy for me to judge, I guess, because I never put myself in that situation. However, it really does beg a belief. Like I'm astounded at the willingness particularly for bank economists, and I get that it's a PR message and they're getting headlines out of it, but I'm astounded at their willingness to keep fronting up with more of this stuff. There was one article which we've quoted in the report where Gareth Aird is the chief economist at CBA, and he was quoted with all his caveats and hedgings and all the rest of it. So it was a classic. It was like, well, CBA says prices are going to do this, but if that happens, they could do that. Or if this happens, they could that. And it was like the article, and it's like, well, of course. And yet the problem, I guess what happens is these press releases go out. A lot of these headlines grab one line, and they will craft a story around whatever angle they choose. One of the things I really did appreciate, and I gave her a gold star actually, was a journalist or the editor of The Advisor magazine, and is it Mortgage Business? Annie Kane? Yeah. Because what she does, she actually regularly reports on what all of them are saying. And she also quite often reviews back to, well, last time they said this and they got that wrong. And I think that's quite good to see in reporting, because you're not often seeing that. A lot of particularly the AFR in particular, a lot of their headlines really grab onto the biggest number, and they're quite scary. I mean, the first one they had one in January. When it comes, it's going to be a long. It's going to be when the price falls come, it's going to be a long run or something like that. It was a particularly doomy and gloomy headline, which I have got in the report, but I can't remember the name of it. And that was looking at, CoreLogic comes out with these charts when the market starts going down. The CoreLogic comes out with these charts showing the speed and rate of decline. And I just always find that interesting, because I do it because I'm a human being, and I look at the rate of decline of the curve that's going down, the thick black line that is the current trend down, and you don't know when the bottom is, and it looks steeper and worse and fiercer than all the other previous downturns that we've had. You know what I mean? And this chart comes out, and Tim Lawless comes out saying it could be worse than the GFC. Now, he's very clever. I do notice that when he comes out with commentary, he never says, I think prices are going to go up 6%, or he never puts a figure on anything, but he does point to what happened in the past and might reference something and say, it could be like that. And I think it's an interesting way to predict without being as easy to hold to account than a lot of these economists. So that's something as well. And so you do see these charts being trotted out. I remember they were trotted out in the last downturn as well. And they're scary. They're very scary.
Yeah, I think one of your quotes you put in the report, which I think our friend Stuart Williams, a lot of people would know who he is, and, he basically said, the behavioural economic part of forecasting property price movements is what's missing in most of the commentary. There was actually someone in the report who sort of really connected. Okay, well, prices are falling, listings are going to fall, and listings of quality properties are going to fall. And I don't think the borrowing capacity reduction, Stuart probably gets it himself, because he's, had a mortgage broking lending background and understands that real connection with not just what the rate at which you borrow at, but also the amount you can borrow and the impact that has on driving booms and busts. We saw that in 2018, the access to credit basically was wiped out with the Royal Commission. That was one of the biggest reasons that 2018, 2019 downturn happened, is because the ability to get a loan was compromised, not even the rate or how much you could borrow. And so I think that's been the really big thing that's played out this year, is the tighter listings, the tighter number of, and then also just this pent up demand that, as prices fall, buyers who ultimately have missed out in previous booms, who ultimately need to enter the market for lifestyle reason, that human side of wanting security and first home buyers entering and people not selling their homes, anchoring buyers. I could have sold it in 2021 for this price. There's no way I'm selling it for this price. I'm not going to move up to Queensland and cash in now. I'm going to stay here for 3 or 4 more years. And so I think that human side is really that stress test or buffer that the property market has, which is different to other asset classes. Like, and investors, for example, also don't run for the hills. I've been a few reports recently. It's like, it's just a knee-jerk reaction. I'm not going to sell my property. Property always goes up. And even investors think like that with property because there's a process to sell a property. You just don't click a few buttons on a trading account. And, so I think all these behavioral things, just people don't see the headlines. And I think people aren't going to see that through the headlines this year when they're all talking about this fixed rate cliff and there's going to be all these delinquencies and the arrears are going to pick up. That's just not realistically going to happen on scale immediately. It may happen in certain pockets. So that's a really good point, Stuart says.
I'm on a personal mission to help more people make better property decisions. And you can find out all about what I'm working on at veronicamorgan.com.au. And there you'll find resources for first home buyers, details about my buyer's agent mentoring program, access to suburb help for investors, or if you're looking to buy your dream home or an investment property in Sydney's inner west, eastern suburbs or lower North Shore, you can connect with my team at Good Deeds Property Buyers.
If you're thinking about buying your first home, upgrading to a new one, or purchasing an investment property anywhere in Australia, we would love to carefully guide you through this journey and importantly get the finance right. Please reach out via our website, wealthful.com.au.
Don't forget that you can download our free full or forecaster report. Which experts can you trust to get it right? theelephantintheroom.com.au.
I think too, remember the principal and interest cliff.
Yeah.
the interest only cliff.
Yeah.
That was back in, when was that? 2017, 18?
2020, I think. Or maybe it's been a bit earlier, actually. Maybe 2019. So it was when interest rates and interest only was all what everyone was basically doing, in the investment boom of sort of 2015, 2016. So you had 5 years on top of that. And I think that's roughly when it would have been. But you're right. That was like, borrowing capacity is not going to allow people to get out of these interest only because capacities are full and the banks are tightening up the rules around interest only. But, bit by bit, investors maybe just sold one of their property or maybe they just were able to extend their terms because they sold one of their properties. It was all a storm in a teacup.
Well, I think that's the important thing, bit by bit. And it's what a lot of these commentary seems to assume is that the entire property owning population of this country is all going to move en masse in reaction to something like the mortgage cliff, right? And so they everyone's going to hurt at the same time. Well, we know that a third of property is unencumbered, right? We know that a third hasn't got a huge amount of debt and a third has got quite a lot of debt, right? So a third of property owners are in that bucket where potentially a lot of those are going to come off this fixed rate cliff, right? So that's true, but still in the whole 10 million properties in Australia, it's still only a percentage and it's dispersed. and it's like, and so when you sort of break it apart and you think, of course, there's not going to be a run on the property market because fact is not everybody has to sell. And then a lot of people will do whatever they can to avoid selling. And let's face it, if you were in a situation where you were staring down the barrel of selling and then you had to go and find somewhere to rent, well, that's not easy either. So it's basically you got a shit sandwich, whichever way you look at it. You got to have your shit sandwich on brown bread, your shit sandwich on white bread. One way or the other, you got a shit sandwich. You have to eat this thing. And that means that you're going to have to suck up your higher mortgage repayments, get a second job, whatever you do, because that's what we do. We actually eat the shit sandwich. Now, I love these news outlets that go running around looking for the sob story of the one couple that is going to sell because of this. And it's like, that's not helping. And as much as I love the ABC, they're particularly bad at this or particularly good at it, depending on your perspective. They love finding that down and out, the sob story. And look, I get that people are hard up. Don't get me wrong. And I'm going to suffer this. Part of my mortgage is coming off a lovely low fixed rate, and I'm going to hurt a bit myself coming June. But the point, I will tighten up my belt. I will make allowances. I will make adjustments. I've got things that I will do to obviously ease that burden. And that's the fact is, it's sort of that behavioral thing that Stuart was referring to. That's the stuff that these numbers, purely using numbers to base these predictions on, it just fails to take into account. And it does make me laugh that once again, we keep seeing this over and over again. And so I just wonder when they're going to learn. Will they learn? Can they learn?
Yeah, and I think the worry with waiting is sometimes you don't understand that other people may also be waiting. So when you all finally wait for this magical event where it's great buying, you also get there and all the herd's there already. And the herd actually says, well, if everyone's waiting for that, I'm going to jump in front of the herd. And then all of a sudden the herd time's actually moving in front of where you think it is. And so you're actually late to the party because everyone else is trying to outsmart the herd and buy a little bit. And I think that's what's already happened in the property market. And I think that's the risk we're going to see in 2023 is everyone's going to be waiting for this fixed rate cliff, right? And what we've seen recently, maybe interest rates have stopped going up. Are we got to this point where there's going to be a pause in the rate cycle? So if you were waiting for this magical moment and now all of a sudden the facts have changed and now the story's changed, well, hang on a sec, now you're going to be reactive and you're going to be entering the market at the wrong time. So it's just one of those problems. I think that's a really there's a lot of graphs out there, some great ones on LinkedIn where people, track sort of forecasts over time, and market expectations of interest rates has been really interesting. We put a graph in the report that basically shows what people have thought over the last 6 months. And you can see in June, the expectations that rates were probably going to end up somewhere around 3. But as it went to sort of July, it was like, hang on, rates are going to go to over 4%. And that was a real freak out moment. I remember that's when a lot of clients very scared in July, me included. I actually bought a property in June and upgraded. And so I was like, whoa, I wasn't expecting this. What have I done? And by the time July sort of came around, it started to come back down to, maybe it's going to be 3.5. And then it sort of spiked again up to 4. And then it ended the year sort of, roughly around that sort of 4 mark. So it's just, and then this year it's done the similar thing. Is it going to go 4? Is it going to go down to 3, etc.? And so it's really hard to base your long-term decisions when the market's just changing its tune so often because new information's coming in and it's just like, what's that mean? What's that mean? What's that mean?
This is so typical of what is wrong about the property market. And it is this short-term thinking around a long-term asset. And this is one of the... Tom Panos came out with a quote on LinkedIn and probably Twitter, probably everywhere actually. It was something like, I'm paraphrasing, and I just thought it was classic. I don't usually comment on things that he says, but this I just thought was brilliant. And it says, you marry the property, but you're only dating interest rates. And it's so true. It's like, the thing is, you've committed to the property. And if you've done your job well in the first place, you've committed to a good property that you should be thinking long term about. It suits your needs and will do so for the long term, and it's worth holding on to. It's really the people that panic the most are people that are short term in their thinking, and they really think, do they really believe that they can ride the property market or in some way control it? And a lot of people do think they can. They think they can work this beast to their advantage, and they fail to see when luck plays. And it could be good luck and bad luck, because at the end of the day, this property market is a beast way bigger than any of us, and way bigger than every single economist and forecaster who has put their name on a number saying that market's going to do this or it's going to do that. All they're really talking about is, if this happens, that could happen. If that happens, something else might happen. And I think that's what's missing in the reporting of these predictions. I know a lot of work goes into coming up with these forecasts. I mean, particularly Felicity Emmett and Belinda Allen. Felicity's from the ANZ, Belinda's from CBA, both of them senior economists, and they came on the podcast. They took the time to explain to us really what goes into these models. And these aren't, it isn't, we might make light of it and say, look, why the hell do they put their name to it? They're part of an institution that will release this information, obviously, and so therefore, they've probably got no control. That's their job to do that, obviously. And I really appreciate it. I'm sure you did too, that them taking the time to explain to us all the inputs and the challenges of trying to get it right. But I also think maybe we should give a gong. Someone said to me the other day, isn't a gong a positive thing, Veronica? But we call, if someone gets a gong in the full forecast report, it's a negative, by the way. But And I actually did look up too, is a gong, I Googled, is a gong a positive thing? But I got this whole thing back about basically Eastern mysticism, which I didn't think quite fit with what I was trying to find out. So I gave up on the search. But anyway, the point being, if we give it a gong, that's because we're saying it's not great. And so, the gong, I think a big gong needs to go to the way the media reports on these predictions. And I know that there's some very good property writers and economic writers who really take the time to try to explain things. And there's others that really do go for the sensationalist headline that really does, I think, is irresponsible personally.
Yeah, I think we've sort of 5 years in a row, and I'm pretty sure next year as well is going to be the same thing where we can see the media storm is going to cause all sorts of overconfidence. And, it was actually just 2 weeks ago, I saw an article that the boom is back, right? And, because you could see that the Sydney prices are starting to stabilise and maybe this month's going up. And, it was all those articles of maybe the bottom's passed and things like that. And, the negative news will flip into the positive news. And we all know that the news companies are all owned by, conflicted interests, and the platforms are owned by different people. And so we've got to be conscious that the money's basically driving a lot of these medias, which is driving the people, which hopefully our listeners aren't buying into. So
one of the gold stars we gave as well was to Scott Pape. And I just thought, I love this. This is and it's not on his website, it's on his email. I think he puts out a weekly email, and I got this one, and it was entitled Launching a Class Action Against the RBA. And it was a letter written in by this guy named Ben, who's very upset, obviously, that he acted on the RBA's advice. If you're good to go because we're not going to raise interest rates till 2024. And I'm going to quote him, and this is why he gets a gold star. Look, no one put a gun to your head and told you to borrow too much money when interest rates were at their lowest levels in recorded history. I've written at this every week for the last decade, mate. So sorry, Ben, I won't be joining your pity party. And I thought that was funny because at the end of the day, it comes back to this long-term thinking that we're always banging on about. This is all short-term. It's all just scaring us one way or the other, scaring us into action, scaring us into inaction. And, we need to take responsibility for ourselves and for our property decisions. These are important, and I know that I'm preaching to the converted with our listeners here. You guys are all smart enough to know this is a long game, to think, buying a good asset, holding on to it, not overextending, et cetera, all good, solid, principles to apply to your life and not be tossed around. But I have to say, I recognize the human behavioral element here because I too, even though I know this, even though I study this, even though I've been in this market through, I think I've worked out about 8 or 9 cycles, I too get freaked out by this stuff, right? So I totally understand why people do knee-jerk, particularly with all this sort of heightened, and I call it misinformation out there. And it's one of the reasons that we do write the report is to try to remind everybody that this is not worth paying attention to other than for a bit of humour in a way.
Yeah, I think that the one thing that downturns and events happen is that I think it's really a time where quality properties versus the, not so much, the dogs we like to call on here, that gap gets big. You can really see the people who have bought the properties that aren't that great are feeling a lot of pain if they have to sell. You can see those properties sitting on the market. There's not many buyers. We had some clients make some crazy sort of negotiations in that sort of August, September, October. While they're not the AAA assets, they got them at very good prices and massive discounts to what they were, for the better properties. And they were aware of those issues, but they were factored into its price, I guess, at that point. And I think this is what the downturns teach you as a property investor is that, what happens to supply, what happens to quality listings, what a human behavior does, the pickiness with interest rates. And so then you get that confidence to say, well, yeah, in those downtimes, my property was fine. No one was rushing for the exits. I know there's long-term benefits with, population growth and the economy and I've got a good asset that's really scarce and I can bet on those long-term fundamentals, not worry about the short-term, blip with the fear in the market. I'm not looking to transact anyway, so I can just turn it off and manage my debt.
And that's the thing, isn't it? Just turn down the noise. If you're not looking to transact, if you're confident decisions that you've made, it's a lot easier to not give any of this airplay. Now, one of the things that we do always bang on about is that quality property and how important that is, and those investment fundamentals, and not being waylaid by clever little, marketing spills and all the rest of it. And certainly encourage you to download the Fuel of Forecaster report, which every year is available on April Fool's Day, and when will be on the website, which is theelephantintheroom.com.au. But one of the things that I'd like to ask you is, well, while you're on the website, while you are downloading the report, if you have a question for us, use the new SpeakPipe thing there. So there's a little button you can press and you can actually record a question for us, as long as it's less than 2 minutes. But the other thing that I'm really keen to get some more stories on, and that are listener stories of poor investment decisions. Now, I know this is not the stuff that you talk about around the barbecue. Everyone's bragging about how clever they are and their good investment decisions. Quite often I hear people bragging about ones that weren't good, but they think they're good. What I'm interested in is evidence and experiences of people that have made decisions probably 5 or 10 years ago, maybe longer, where at the time you thought it was the right thing to do. You might have followed, conventional wisdom at the time. You might have followed a spruiker. You might have followed a property expert that had some strategy. And after time, you've realized the flaws in that strategy or the flaws in that thinking. And the reason I'm asking you to share those with us is because we really want to, create a cautionary tale for people. There's always a new breed of property, guru coming out selling their latest strategy for a whole new generation of people to make those same mistakes. So same shit, different shovel. We just would love to have some evidence there to show stories. And so we're not wanting to make a bad example of anyone. We're really wanting to create a cautionary tale. So I just thought, while you're there on the website, if you can send us an email or even a SpeakPipe and just tell us your story, we'd really value that. And we want to turn it into some sort of resource that is really helpful for the next generation of property investors.
Look, I think that's amazing. I definitely throw your questions in there. We love the Q&A, and it's nothing better than hearing your voice as well, given we're a podcast. I think that's just why we talk about the Dumbos, and, we want those stories is, as a broker, as an ex-planner, I speak to lots and lots of people every single week. And if we accumulate those stories over 10 years, that's where our learnings have come from. The same for Veronica. It's understanding, why did you buy that property? What happened? What's happened to it? What's the growth? Comparing that, etc. And, when you're hearing these stories, you can see similar trends where people have made different decisions and ultimately ended up in different places. And so if you've got some stories to share, we've got a pretty bad story at the moment. A client off the plan, purchase and tried to sell it, but then there's building issues that are ongoing, and he, wants to upgrade, really needs to upgrade, but just can't sell the asset. And, it's a real tough one. I mean, a client, last week as well, 2 off the plans in sort of inner city, pretty popular development in the inner city, actually. And, won awards, etc. This building, but the apartments themselves were overpriced. And those apartments have done nothing in well over a decade. And, the sunk cost bias here, the holding costs, the opportunity cost, actually family, emotional element here where they just want to sell where they make a profit. And so, there's lots and lots of stories Veronica and I hear, and that's what we try to do through this podcast is educate. Well, you did make that decision. This is ultimately where it's going to affect you, and this is what a better decision could be.
If you have a question that you'd like us to answer in an upcoming Q&A episode, you can send us a voicemail or written question via the website, theelephantintheroom.com.au, or you can email us directly at questions@theelephantintheroom.com.au. If you like what you're hearing, please share this episode with others you feel would benefit. And while you're at it, why not leave us an iTunes review? 5 stars would be great. I know that sounds a bit cringy, but we have it on good authority that every review helps make it easier for other people to find out about us and hear what our amazing guests have to say.